Right now, the silver market is facing something we haven't seen in decades. Imagine this. Investors are demanding 4 times more silver than actually exists in the vaults. That's not a typo. 4 times. Physical silver is disappearing fast. Contracts are being called for delivery like never before, and major dealers in Europe are reporting being completely out of stock. What you're about to see could shake the way precious metals markets work forever, and it might start hitting hard as early as this March. If you thought paper promises were safe, think again. Let me break down what's happening. Currently, there's roughly 100 million ounces of registered silver available on COMEX, the silver that's physically ready to be delivered as contracts mature. But the March contract alone is talking about nearly 400 million ounces, 4 times what's actually available. That gap is massive, and it's creating intense pressure on the system. The big question is, will investors roll over their contracts to the next delivery month, or will they insist on actual delivery? And the behavior we've been seeing recently suggests that people are going to want their silver, not just paper claims. Look at February. Typically, only a small fraction, 5 or 10% of contracts are called for delivery, but last month, every single contract requested physical metal, 100%. People didn't just settle for paper. They wanted what they were promised in reality. January was similar. This isn't happening in the front months where trading is heavy. It's happening in larger, less traded contracts. And March is a key month, with open interest around 76,000 contracts, and the first delivery day coming at the end of February. What happens next could be extraordinary. Will those contracts vanish as deliveries are made, or will they roll to May? Either way, the tension in the market is building. Another piece of the puzzle is the role of silver ETFs, especially ones like PSLV. When you buy shares in these ETFs, the provider is buying physical silver and putting it into secure vaults. That's how your investment is backed by actual metal. But if silver is scarce, they can't create new ETF units. And if the ETF can't create units, trading could be halted because the ETF would no longer accurately reflect the net asset value. This is more than a technical detail. It's a warning sign. Historically, when silver prices soared, ETF shares would drop because the physical metal was being claimed and removed from the exchange. Now, after recent price corrections, those ETF shares are rising again. That makes it harder for bullion banks to lease silver for delivery, and the shortage becomes even more acute. Essentially, it turns into a high-stakes game of musical chairs. Everyone needs the same metal, but there isn't enough to go around. One day, that pressure is going to explode, and March could be the tipping point. We're already seeing this globally. In China, for example, one silver trust suspended the creation of new units because demand outpaced available supply. At one point, units on the secondary market were trading at double their net asset value. This isn't just unusual, it's a sign of systemic strain. Over in Europe, major bullion dealers are saying they haven't been able to get silver for weeks. The COMEX March market is essentially broken. Buyers want 400 million ounces, but only 100 million exist in the vaults. Last month, for the first time ever, every single contract requested delivery. No one rolled over paper contracts. This is a full-blown rush for physical silver, fueled by a loss of confidence in paper promises. And it's not hard to understand why investors are acting this way. Over the past few years, counterparty risk has become very real. People have seen bank bail-ins, frozen assets, and devalued currency. They don't trust ETFs, unallocated accounts, or even allocated holdings anymore. They want metal they can hold themselves, ideally outside the traditional banking system. This demand isn't just coming from private investors. Central banks quietly have been steadily increasing their gold reserves for years. Some countries have even been buying physical gold month after month, sometimes publicly, sometimes behind the scenes. Private wealth, family offices, and hedge funds are following suit. Everyone is realizing that debt bubbles and currency risks are not abstract threats. They are real, tangible risks to wealth. So what does this mean for pricing? If silver levels continue to fall while demand for delivery remains high, the market is going to respond. Prices will be pushed upward until supply finally meets demand. If the COMEX doesn't intervene with extreme measures like cash settlements or halting trading, this could get very dramatic. When you have 4 times more demand than supply, the price has no choice but to rise rapidly. This is basic economics playing out in a high-stakes environment. Part of the reason investors are so focused on physical metal comes from experiences like Cyprus in 2013. Banks collapsed and deposits over the insured limit were essentially seized and converted into bank shares. Depositors lost direct access to their money, and ATMs often dispensed only tiny amounts. That event wasn't just a one-off, it served as a cautionary tale, demonstrating that relying on banks and paper promises can be risky. Now, people are choosing silver and gold precisely because it removes that counterparty risk. They want assets they can touch, store, and control themselves. Even regulatory changes hint at underlying concern. In some regions, insured deposit amounts have been raised significantly, suggesting authorities recognize potential systemic risks. Investors are reading these signals and acting accordingly, moving funds into physical metals to protect their wealth. It's not about speculation anymore, it's about security and certainty. Paper holdings, whether through banks, ETFs, or other intermediaries, are only promises. They claim someone is holding metal for you, but the risk is real that the promise might not be fulfilled. Physical ownership eliminates that risk. You don't need permission to access your holdings, and you're insulated from policy changes or sudden freezes. That peace of mind is fueling a surge in demand that the market has never seen before. The open interest on COMEX suggests that demand for delivery may continue climbing. Even in months that aren't heavily traded, January and February saw large percentages of contracts executed as physical deliveries. If March behaves the same way, it could mark another historic period in the silver market. Technically, COMEX has the option to default to cash settlement, but doing so would damage its credibility. Traders expect the exchange to deliver if contracts demand it, and failing to do so could have lasting consequences. If the long positions, the ones holding contracts for physical delivery, insist on taking metal, prices could be squeezed upward sharply. We may not know who exactly is behind each contract, who's short or who's buying, but the pressure is clear. This is about structural market risk. Unprecedented demand, shrinking inventories, and distrust in paper instruments are combining to create conditions where traditional supply-demand logic is being tested under extreme stress. The broader context is also important. Since 2022, geopolitical events and disruptions in traditional financial systems have driven central banks and private investors to secure tangible assets. The rush for physical gold and silver is no longer speculative, it's strategic. Countries and investors want security, control, and stability amid global uncertainty. This fundamental shift in investment behavior explains why ETFs, COMEX deliveries, and physical inventory levels are so critical right now. At the end of the day, the silver market is under intense pressure. Shortages, high demand, and delivery obligations are converging to create the perfect storm. Prices are likely to respond rapidly if supply continues to lag behind demand. This isn't hypothetical, it's happening. Physical metal is in demand like never before, and the market is being forced to adjust. For investors and observers, this is a turning point. Long gone are the days when paper promises were sufficient. The market is being reshaped by the urgent need for tangible physical assets. Whether you're an individual, a hedge fund, or a central bank, the lesson is clear. Control over real metal matters more than ever. Watch COMEX, watch ETF activity, watch bullion dealers. The coming weeks could redefine how silver and possibly other precious metals are valued and traded globally. In short, this isn't just another market cycle, it's a wake-up call for anyone relying on paper instruments. The silver squeeze is real, it's happening now, and the implications for pricing and delivery are enormous. Physical metal is king, and if the current trends continue, we could see prices accelerate faster than anyone anticipates, driven by real demand in a world that no longer trusts promises on paper. Now, I want to ask you, do you trust the paper price of silver or are you stacking physical metal? Let me know your thoughts in the comments below. And if you want to stay ahead of this crisis, make sure you hit that subscribe button so you don't miss what happens next. Thanks for watching.